profit margin of 7.29% compared to Virgin Australia's negative 12.48%, we can deduce that Air New Zealand is more effective at managing their operating expenses and retaining a higher percentage of their revenue as profit. Virgin Australia made a loss, evidently leaving no dividends for its shareholders. For the period 2017 to 18, for every dollar of their assets, Air New Zealand produced 5.14 cents of profit. Virgin Australia, however, produced a loss of 10.42 cents for every dollar of their assets. Virgin was ineffective at using their assets to generate profit. Return on equity measures profitability from the perspective of the ordinary shareholders. Per dollar of shareholder equity, Air New Zealand produced 18.55 cents of profit for their shareholders. This is a high rate of return, making the company a good investment for shareholders. Virgin Australia, however, made a loss of almost 50 cents per dollar of shareholders' equity. They were extremely ineffective at using capital to generate profit, and shareholders of Virgin Australia can be expected to be disappointed in their decision to invest in this airline. Overall, based on these profitability and performance ratios, we have observed that Air New Zealand was substantially more effective than Virgin Australia at generating profit, and in terms of immediate shareholder return is the obvious choice for investors. Now we look to liquidity. Examining current ratios, Virgin Australia and Air New Zealand both exhibited liquidity and an ability to meet their short-term obligations, though Air New Zealand is slightly more liquid than Virgin Australia. The quick ratio measures an entity's immediate short-term liquidity based on the quantity of their assets that is highly liquid and can be used to meet obligations immediately. Once again, Virgin Australia and Air New Zealand have similar rates of liquidity, with Virgin in just a slightly lower position of financial stability. Both companies' quick ratios sit just below the minimum standard, however, making their ability to meet debts somewhat questionable. Asset turnover shows that Virgin Australia is more efficient than Air New Zealand at using their assets to generate sales. Despite their inability to use assets to generate profit, which was examined previously, this indicates that they are good at using their assets to produce revenue, but their overall loss and downfall must stem largely from their inability to manage their expenses. Virgin Australia converted their receivables to cash 2 more times in an annum than Air New Zealand did, demonstrating their higher level of liquidity. Air New Zealand's credit customers took longer to pay their debts than Virgin Australia's customers, making them less liquid than Virgin Australia, as accounts receivable took longer to be converted to cash. Overall, Virgin Australia has demonstrated a higher level of liquidity and ability to meet their short-term debts than Air New Zealand, indicating better management of their liquidity and cash flows. Air New Zealand did not follow far behind, however, and are also well able to meet their short-term obligations. Now we look to capital structure and solvency of the two companies. 82.31% of Virgin Australia's assets were provided through debt financing, 10% more than Air New Zealand. Both companies are at risk that they may not be able to meet their long-term obligations, with Virgin at a higher risk. Both companies have a high ratio of debt finance in proportion to owners' funds, obtaining most of their funds through debt. Virgin Australia's ratio is almost double that of Air New Zealand, with a striking debt-to-equity ratio of 465.15%. At this extremely high rate, the company faces high risk of insolvency and liquidation should profits falter. Virgin Australia's last 2 years of loss lead us to question their current risk of bankruptcy. Air New Zealand has a current interest ratio of 6.78 to 1, putting them well above the desirable minimum ratio of 3 to 1, demonstrating a strong capacity to meet their interest payments with current profit levels. Virgin Australia's ratio, however, is glaringly low at negative 0.52 to 1, indicating an incapacity to meet their interest payments. So Air New Zealand has demonstrated solvency and comfortability to meet their long-term obligations. It has been uncovered that Virgin Australia, however, is at a very high risk of insolvency and liquidation. So the clear message here to investors is that Air New Zealand is a far safer and more profitable investment option than Virgin Australia, and would be the obvious investment choice.